Every time you pay your mortgage or browse online real estate listings, you are relying on a hidden financial safety net that dictates where homes can even be built. Yet the standardized federal flood insurance program we know today was not introduced until 1968. Before that year, a rising river or a coastal storm surge meant total, unrecoverable financial ruin for anyone caught in the water's path. So how did we transition from a system where nature's destruction was a personal tragedy to one where the taxpayer absorbs the risk of coastal living? The answer is not just a story about weather, but a century-long battle over who holds the ultimate financial liability for the American dream. It is a tale of failed private markets, political opportunism, and massive geographic engineering. In the 19th century, settling near water was an absolute economic necessity for trade and agriculture. Towns clustered tightly along the banks of the Mississippi, the Ohio, and the Missouri rivers. When those rivers inevitably breached their banks, the financial fallout fell entirely on the individual property owner. Local municipalities attempted to mitigate this risk through sheer physical force rather than financial instruments. Hand-drawn county engineering ledgers from the 1800s show massive local expenditures on earthen levees and retaining walls. There was no insurance policy to buy, only the hope that the town's dirt mound would hold back the spring thaw. Private insurance companies did briefly attempt to turn a profit on flood risk during the late 1890s. A handful of regional carriers offered water damage policies to merchants operating in dense riverfront districts. However, the fundamental mathematics of insurance completely collapsed when applied to mass flooding. Fire insurance works because a single house fire rarely burns down an entire city, allowing the premiums of the many to cover the losses of the few. Actuarial tables from early 20th century insurance firms revealed the fatal flaw of flood coverage. When a river floods, it destroys every single insured property in the portfolio simultaneously. This catastrophic concentration of risk forced the private insurance industry to rapidly abandon the flood market altogether. By the early 1920s, nearly every private insurer explicitly excluded flood damage from their standard property policies. If you lived near the water, you were entirely on your own. This absolute vacuum of financial protection set the stage for one of the greatest economic disasters in American history. Throughout the early 1920s, aggressive agricultural expansion pushed settlements deeper into the natural floodplains of the lower Mississippi Valley. Farmers relied entirely on local levee boards, trusting patchwork defenses maintained by disjointed local authorities. In the spring of 1927, months of relentless rain swelled the Mississippi River to unprecedented levels. The raging waters shattered the local levee systems in 145 different places, creating an inland sea roughly the size of New England. Hundreds of thousands of people lost their homes, their crops, and their life savings in a matter of hours. The Great Mississippi Flood of 1927 proved that local governments and private charities were hopelessly unequipped to handle basin-wide destruction. Black and white newsreels broadcast images of submerged towns to audiences across the nation, shifting public opinion toward federal intervention. Suddenly, the financial devastation of river communities became a problem of national economic security. Lawmakers in Washington realized they could no longer ignore the economic paralysis caused by major flood events. But rather than offering insurance to individuals, Congress decided to declare war on the rivers themselves. The passage of the Flood Control Act of 1928 fundamentally altered the federal government's relationship with natural disasters. The 1928 legislation authorized the Army Corps of Engineers to design and construct a massive, federally funded system of levees and spillways. Appropriations bills from that session show millions of federal dollars being poured into concrete and steel to tame the Mississippi. The government chose to subsidize physical protection instead of providing financial indemnification. For several decades, this strategy of massive federal engineering created a dangerous illusion of absolute safety. Believing the rivers were finally conquered, developers accelerated the construction of residential neighborhoods directly inside historic floodplains. The physical risk was growing exponentially, but the financial risk still rested entirely on the shoulders of the oblivious homeowner. As the mid-20th century approached, the demographic center of the United States began to shift dramatically toward the coasts. Post-war prosperity fueled a massive boom in beachfront property development, from Florida to the shores of New Jersey. Americans were flocking to the water's edge, completely unprotected by any form of standardized disaster insurance. Private lenders began issuing 30-year mortgages on coastal properties, willingly ignoring the glaring absence of flood coverage. Bank ledgers from the 1950s show billions of dollars tied up in coastal real estate, backed by absolutely zero flood protection. The entire American financial system was blindly betting against the ocean. It was a precarious financial house of cards, just waiting for a strong enough wind to blow it down. The federal government had successfully managed river flooding through engineering, but the ocean could not be walled off with concrete. The stage was set for a devastating hurricane that would force Washington to finally underwrite the risk of the rising tide. The post-war coastal boom faced its first severe test in the early 1950s, not from the ocean, but from the sky. In the summer of 1951, record-breaking rainfall triggered catastrophic flooding across Kansas and Missouri. The resulting property damage exceeded $1 billion, bankrupting thousands of families and local businesses overnight. President Harry Truman recognized the glaring hole in the American financial safety net and appealed directly to Congress. He proposed a massive federal disaster insurance corporation, arguing that private industry simply could not handle the scale of atmospheric risks. Congressional Budget Committee transcripts from 1952 show lawmakers balking at the estimated costs, ultimately killing the proposal entirely. For the next decade, the government reverted to its standard playbook of offering low-interest disaster loans instead of actual insurance. But a loan does not replace lost equity. It merely adds new debt on top of a destroyed asset. Homeowners were left paying 30-year mortgages on houses that had literally washed down the river. The tipping point finally arrived in September of 1965 when Hurricane Betsy slammed into the Gulf Coast. Betsy was a monster of a storm, pushing a catastrophic 10-foot storm surge directly into New Orleans and the surrounding parishes. It became the first billion-dollar hurricane in United States history, leaving absolute financial devastation in its wake. Thousands of newly built suburban homes were inundated, wiping out the primary source of middle-class wealth for an entire region. Bank executives suddenly realized that their localized mortgage portfolios were functionally worthless without a mechanism to rebuild the collateral. The banking lobby, terrified of mass defaults, joined forces with displaced homeowners to demand a permanent federal rescue. Lawmakers could no longer rely on disaster loans to patch up a fundamentally broken real estate market. President Lyndon B. Johnson responded by convening a specialized task force on federal flood control policy to study the crisis. In 1966, this group delivered a pivotal report declaring that structural engineering alone could never defeat nature. The task force concluded that the only viable solution was a federally subsidized insurance program tied directly to strict local zoning laws. This intellectual framework laid the foundation for a radical shift in American housing policy. In 1968, Congress officially passed the National Flood Insurance Act, forever altering the landscape of real estate. For the first time, the United States government stepped in to underwrite the existential risk of living near the water. The new system required a massive cartographic effort to determine exactly who was actually in danger. Government hydrologists began drafting detailed flood insurance rate maps, officially delineating the boundaries of the 100-year floodplain. These massive paper maps dictated the precise geographic zones where federal insurance would be legally required for any federally backed mortgage. But this insurance was not offered as an unconditional blank check to property owners. The federal charter explicitly required local municipalities to adopt stringent floodplain management ordinances in exchange for access to the coverage. Town council ledgers from the early 1970s document local governments scrambling to raise minimum elevation standards to qualify their citizens for the federal safety net. To encourage rapid enrollment, the government offered steep premium subsidies for homes that already existed in hazardous zones. Actuarial pricing models were temporarily set aside, meaning the actual cost of the flood risk was absorbed directly by the taxpayer. The overarching goal was to secure widespread community participation first, with the assumption that strict building codes would eventually phase out the riskiest properties over time. The initial rollout of the 1968 program was surprisingly slow, as many communities resented the federal interference in their local zoning authority. However, subsequent floods quickly proved that towns without federal coverage faced insurmountable economic recovery hurdles. Slowly but surely, the American real estate market became fundamentally addicted to the guarantee of cheap federal flood insurance. Developers realized they could now build in highly vulnerable coastal areas because the federal government had essentially removed the financial peril. The era of personal financial ruin from flooding was over, but a new era of massive taxpayer liability had just begun. The original 1968 legislation offered a financial lifeboat, but to the government's dismay, very few communities actually climbed aboard. By the early 1970s, participation in the federal flood program remained stubbornly low as local mayors refused to implement the required zoning restrictions. It took another massive disaster, Hurricane Agnes in 1972, to force Washington to give the system teeth. Congress responded with the Flood Disaster Protection Act of 1973, which fundamentally altered American banking compliance. The law mandated that any property located in a high-risk flood zone must carry federal insurance to receive a mortgage from a federally regulated lender. Loan officer compliance manuals from the mid-1970s suddenly featured strict checklists requiring proof of flood coverage before a single dollar could be dispersed. This banking mandate transformed the federal flood maps from obscure government documents into the most powerful real estate instruments in the country. The Federal Emergency Management Agency eventually took over the cartography, drawing lines that could instantly alter a property's market value by tens of thousands of dollars. An assessor's zoning ledger now dictated whether a family could afford to buy a home, based entirely on which side of a printed ink line the foundation sat. To properly rate the remaining risk, the government introduced a new, mandatory piece of paperwork for coastal residents. The standardized elevation certificate required a licensed surveyor to physically measure the height of a home's lowest floor relative to the projected floodwaters. These stamped surveyor documents became the ultimate arbiter of a homeowner's monthly premium, permanently linking architectural design to insurance economics. However, to keep the political peace, Congress intentionally suppressed the premium rates for older homes built before the maps were drawn. Historical actuarial ledgers reveal that these grandfathered properties were paying a fraction of their true mathematical risk. The federal government was essentially running an insurance company that was legally forbidden from charging enough money to cover its inevitable losses. This structural deficit created one of the most profound moral hazards in modern American economics. Because the catastrophic risk was heavily subsidized by the inland taxpayer, developers aggressively bulldozed fragile coastal dunes and wetlands to build luxury vacation homes. The guarantee of a federal bailout incentivized the wealthiest demographics to build in the most dangerous environments on the continent. The deepest flaw in the system became the phenomenon of the severe, repetitive lost property. Claims adjustment spreadsheets from the 1980s and 90s showed single addresses flooding and being rebuilt at taxpayer expense 5, 6, or even 10 times. Instead of moving people away from the water, the insurance program actively funded their return to the exact same hazardous footprint. The environmental consequences of this financial guarantee were equally devastating. By removing the financial peril of building on the water, the government inadvertently funded the destruction of natural flood barriers. Coastal management reports from the late 20th century document the widespread paving of vital wetlands, ironically increasing the severity of future floods for everyone else. By the early 2000s, the catastrophic mathematics of this arrangement finally caught up with the federal treasury. Massive storms like Katrina and Sandy completely overwhelmed the program's collected premiums, forcing it to borrow tens of billions of dollars directly from the federal government. The National Flood Insurance Program morphed from a self-sustaining safety net into a massive, heavily indebted entitlement program. Recent attempts to fix the pricing structure have faced fierce political backlash from coastal representatives. When Congress tried to implement actuarially sound rates in 2012, outraged homeowners facing premium spikes forced a rapid legislative reversal. The political reality is that removing the subsidy would instantly crash coastal property values, creating an unacceptable, localized recession. Today, the federal flood insurance system remains trapped between the rising reality of coastal weather and the political impossibility of charging market rates. We transformed a catastrophic personal risk into a shared national burden, but in doing so, we essentially financed the destruction of our own coastlines. As the waters continue to rise and the financial deficits grow, we face a profound choice. Should the general public continue to subsidize the extreme risks of coastal development, or is it time to force waterfront property owners to pay the true cost of nature's wrath? Subscribe to our channel to uncover more of the hidden historical architecture and financial systems that shape the modern world.